Daniel Crosby, The Laws of Wealth, Psychology and the Secret to Investing Success. In the book Summary of The Laws of Wealth, Psychology and the Secret to Investing Success by Daniel Crosby, you'll learn how your mindset and emotions profoundly affect your investment decisions. Delve into the world of overconfidence bias, how negative and positive emotions impact your choices, and the advantages of hiring an investment advisor. Discover the importance of analyzing executive actions, the rationality behind value stocks versus glamour stocks, and the potential risks of investing in the new and exciting. Finally, understand the significance of aligning your financial decisions with your personal goals and dreams.
Overconfidence bias in investing. Overconfidence bias is a common phenomenon where people overestimate their abilities and perform in a manner that they think is superior to others. This bias can have a profound effect on investing since it can lead individuals to make risky and uninformed decisions. Overconfident investors credit their wins to their talent and believe their losses are circumstantial, leading to a fundamental attribution error. To become a good investor, one must be humble about their abilities, identify mistakes, and learn from them. The emotions of investing. Extreme emotions, whether negative or positive, can have a significant influence on decision-making skills, particularly in investing. In an experiment conducted by social psychologist Jennifer Lerner, participants who watched a sad movie made comparatively worse investment decisions than those who watched a dull video clip. Similarly, experiencing positive emotions like excitement may lead to irrational behavior. A group of students from an experiment carried out by behavioral economist Dan Ariely showed reckless decision-making tendencies after viewing pornographic images. The takeaway is that emotions can affect investment decisions, and the best way to tackle them is by getting an investment advisor. The role of advisors in investment. Investors often know the rules of investing but lack the discipline to stick to their plans. Hiring an advisor may bring substantial financial gains and support in times of crisis. Financial analysts have shown that having an advisor leads to outperforming other investors. Not only do advisors provide statistical insights, but they can act as behavioral coaches, challenging their clients' investment decisions and helping them do a pre-mortem. However, choosing the right advisor is crucial. One must check credentials, investment philosophy, communication style, and whether they provide behavioral coaching. Don't panic, stock market dips are normal. As an investor, hearing news of market dips can be frightening, but reacting out of fear can lead to poor decisions. The media tends to exaggerate the impact of dips, but in reality, they are common and do not greatly affect long-term stock portfolio value. Selling stocks during a dip can cause significant losses. High valuations can indicate a bubble, and a drop in prices can actually make the market safer. Successful investors weather market tremors without panicking. Investing in honesty. Trusting executives through their investments. Wall Street's con artists acts as a warning for us to avoid investing in fraudulent schemes. Nevertheless, detecting these fraudulent individuals is not an easy task. Even though we assume that we are capable of detecting when someone is lying, researchers have found that people are awful at detecting lies. In fact, we are more likely to determine who is lying by flipping a coin than by analyzing their behavior. Even people with adequate training, such as law enforcement professionals, are not proficient at identifying liars. As investors, we need to stop listening to what executives are saying and begin analyzing their actions. Specifically, we need to pay attention to how they invest their own money. Managers possess intimate knowledge about the company they work for, so if they are investing in it, it must be a good bet. A study conducted by Tweedy, Brown, a private investment firm, discovered that companies with significant insider buying patterns outperformed other companies on the stock market. They gained 2 to 4 times as much value during the same period. In conclusion, we should concentrate on the actions of executives rather than their constant talk about their companies because actions speak louder than words. Beware of the glamour. The pricing of stocks is not always rational, and we often assume that expensive stocks are valuable based on their price alone. However, this bias can lead to poor investment decisions and unprofitable investments. Research has shown that people derive more pleasure from wine they believe to be expensive, even if it's not, and the same mentality can be applied to stocks. Glamour stocks, like fast-growing startups, may seem like a smart investment because of their popularity, but they can be risky and overpriced. Instead, investing in value stocks, which may be unpopular but have room for growth, can lead to a more sensible and profitable investment. Beware of investment fads. The allure of investing in something new and exotic has a long history of ending in financial disaster. Whether it was the tulip bubble in the Netherlands in the 1600s, the dot-com bubble in the 1990s, or investing in the air travel industry, the temptation of excitement has led to poor investment decisions. The lesson is to recognize the substance behind the beauty and excitement of these new opportunities before investing. Otherwise, investors risk making poor, irrational decisions based on excitement and not sound financial analysis. Discovering your personal financial benchmark. In determining how much money is enough, the book suggests that looking inward instead of outward is the best way to answer this question. People have their own hierarchy of needs that must be fulfilled to gain fulfillment in life. After attaining fundamental human necessities like food and shelter, personal needs may differ. For one, security in funding their children's college education may be the major concern, while creating experiences like traveling the world may be the other's priority. To survive market turbulence while maintaining one's mental health, it is important to understand and articulate these personal benchmarks. Personal benchmarks influence investment decisions. For instance, having a benchmark of 15 years in mind ensures that value stocks recover while not being bothered about dips in the market. However, if an individual is offering support to someone with unpredictable healthcare costs, a less risky investment plan will suffice. To ensure financial decisions are in line with goals, it is important to label money's purpose and use behavioral psychology in decision-making. By doing this, people can proactively align their decisions with their dreams and goals.
The Laws of Wealth offers invaluable insights into the psychological aspects of investing. Through various examples, it demonstrates how overconfidence and emotions can lead to poor investment decisions, and highlights the importance of adopting a humble and balanced approach. The book also stresses the benefits of seeking guidance from investment advisors who can help in making rational choices. It emphasizes how avoiding the allure of glamour stocks and focusing on value stocks while aligning investments to personal values lay the foundation for investment success. By understanding and implementing these lessons, you will be better equipped to make informed and successful investment decisions.